So as you guys know, because you registered for the course, obviously, I'm going to walk through my top personal finance tips for small business owners. So we're going to jump right in with a couple of stats first. So over 99% of America's companies are small businesses. So this is basically defined as businesses that have 500 or less employees. And to break it down even further, 20% of these have employees and the remaining 80% have no employees at all. So that means a vast majority of the small businesses are 100% owned and operated by the entrepreneur. So this means that our overall economy is greatly influenced by small businesses, and they're critical for economic growth. So small businesses actually generated 1/3 of the total U.S. exports. Last year, this totaled about 1.3 trillion. So this means that small businesses created almost 500 billion of total exports for our nation. Now, about 20% of small businesses do not survive their first year of operations, and about half within 5 years will fail. And the second most frequent reason why these businesses happen was because of inadequate finances. And we also know that the most common source of finances for these small businesses is personal and family savings. So as we can see, small businesses are necessary to support the economy, but to take care of your business, you have to take care of your personal finances. So with the majority of the businesses, 80% being owned and operated by a single individual or very small teams, it's apparent that your finances are related to your business and greatly intertwined with your personal finance. So it's important that you build a good foundation, that you build good discipline, and you build good habits, starting with your personal finances, which will influence your decision making when it comes to your business. So the first tip that I have for small business owners, this actually goes for anyone, is to build an adequate emergency fund. So we all know emergencies are inevitable and they're bound to happen. It's just a matter of when it will occur. Now, everyone should have an emergency fund, but this is even more important for business owners. So with businesses, we know that there will be your typical business cycles. There are going to be ups, there are going to be downs. So it's necessary to be able to withstand those times. And we all know that stressful situations can cause us to make desperate decisions that we typically wouldn't make under normal circumstances. So an emergency cushion will allow you to make better decisions and give you a little bit of a peace of mind, since your judgment won't be as clouded by financial worries. Now, with that said, small businesses were hit very hard this year with the COVID-19 crisis. So about 83.5% experienced negative impacts from the pandemic, and about 31.4% expect that it will take more than 6 months for their business to recover, if they recover at all. So I usually advise individuals to have an emergency cushion of at least 3 to 6 months of expenses across the board. But I would advise business owners, particularly small business owners, to save at least 6 to 12 months of living expenses, so double the amount of someone that may have an employer, especially when your business is your sole source of income. So of course, this is not a one-size-fits-all formula. So you would just need to consider some other factors. For instance, maybe your line of work. So say you have a business where your income is solely based on your physical labor. What happens if you get sick and you can't work for a period of time? So you may want to consider building a bigger cushion for yourself. You should also take into account your personal sense of security. How much savings would allow you to sleep just a little bit better at night if something were to happen? So to determine the exact amount that you would need for your emergency cushion, I would say you need to determine what I call your triple B. So this would be your bare bones budget. So this is for the worst case scenario. So say your business earns $0 for the month. Which expenses do you have that you will still need to take care of for your personal well-being? So we all know at the minimum, you will still need to cover housing, whether you have a mortgage or whether you have rent. You'll need to cover utilities, groceries, and transportation. So that's why I said this amount can vary from person to person, because obviously these expenses could look very different from individual to individual. So you would need to take your bare bones budget and multiply that by the number of months that you would like to establish your emergency stash for. And now for your emergency stash, I advise that this fund is kept as liquid as possible. So that means that you can draw cash relatively quick and simple. So you don't want to tie up this cash in any kind of risky accounts like the stock market that you can't readily access or you stand a chance to lose it. So a good place for this would be a high yield savings account that is insured by the FDIC up to $250,000. This way you can earn some interest and not risk losing any money up to the insured amount of $250,000, of course. Now this slide is kind of showing your difference between the online savings bank versus your big bank, which would be like your big brick and mortar banks that you would drive past every day. And so for online banks, you will typically have higher yields over your typical popular big name brick and mortar. So for example, one of the higher yielding online banks right now has an interest rate of 1.1%. And that's actually lower than the usual, just given the current economic circumstances. This same time last year, the interest rate was more around the 2% mark. Now this is versus your popular brick and mortar banks. It only offers a rate of 0.01% of your savings. So to put this in more simple terms, say we want to put up $20,000. Now, if we put this $20,000 in an online savings account at the 1.1% interest rate, we will earn $220 versus the same exact $20,000. If we put this into a savings account at one of the more traditional banks at the 0.01%, you will only earn $2, which is virtually nothing. And when you actually account for inflation, you are probably losing money. The point number 2, you want to find and establish your dream team of subject matter experts. And preferably this would be consultants that have experience in your particular industry. So first, this would include an attorney that would advise and handle any liability issues that may come up, of course, any legal issues that may come up. You also want to include a financial planner to get advice on investment options as you grow, and also to deploy your capital in a better manner and to start your retirement savings options after, of course, you establish your emergency cushion. And last but not least, I would say you'll want a certified public accountant, the CPA, or an enrolled agent on your side. So they can help you, they would advise on the business structure and the tax implications of each. So if you're a new business, you want to do this in the very beginning of when you start your business to make sure you have that structure in place that's going to minimize your tax burden. And also your CPA is going to help you with bookkeeping and reporting needs, of course. So this is necessary to analyze your finances and the profitability of your operations. So these are critical to know. You need to know what your numbers are to assess whether you're profitable or not. So this may include your CPA breaking down your product costs so that you can set prices appropriately and reach the margins that you want. They can also compile and send you monthly reporting packages so that you can see how you performed over time. And they'll give you a picture of your current financial positions. So these reports are critical when it comes to raising capital whether you're going to a bank to get a loan or whether you're going to investors and they will own a share of your company. A lender or an investor will want to see how much you have in assets, how much you made in revenue and net income. And so they will want to know these things so they're not deploying their capital on a risky loan or a bad investment. So as I stated before, taxes is a very big component of why you will want to employ a CPA. So of course, that goes without saying, of course, they will prepare your various returns. So that would include your income tax. It may include your sales tax, your estimated quarterly tax payments. But more important than this, I would say, is tax planning to minimize your tax owed. So taxes will easily be one of your highest expenses. So it's critical to meet with your CPA or your enrolled agent well in advance before your tax return is due, so you can plan and discuss strategies to lower your tax bill. So trust me, if you walk into your CPA's office in March and April when they're buried in work with questions and when they're buried in work with, and you ask them questions about lowering your tax bill, I can almost guarantee you that it's too late at that point. Tax planning should be an ongoing conversation between you and your CPA, especially since you're required to pay estimated quarterly taxes anyway. If you expect to owe tax of $1,000 or more, you should be paying estimated quarterly taxes to the IRS. And this will kind of lessen the blow at the end of the tax year, so you're not sending the IRS this huge sum because you've already paid some amounts towards that tax burden already. So they will help you put those strategies into place to lower your tax bill for the upcoming tax season. And they can also help determine the proper business structure for you related to tax implications. Once again, this is not a one-size-fits-all solution. There's not one particular business structure that is preferable over another one. It will take someone to look at your particular situations and tailor that decision to you. So number 3, we want to keep business and personal finances separate. So do not commingle funds for your personal and business finances within the same bank accounts. The income generated from your business belongs to your business, not you. So do not use business income for personal expenses. So depending on the established business structure, you can transfer funds by paying yourself a salary or making a distribution from the business account to your personal account to handle those personal expenses. So that was number 1. You do not want to commingle those funds into the same bank account, and for a couple of reasons. First, it helps you just establish more credibility and legitimacy as a business. This is one key test that the IRS uses to determine if an activity is a bona fide business versus a hobby. So there are very different tax implications among the two, with the classification as a business obviously being more favorable for tax purposes. So in the instance where you're commingling business finances and personal finances, and the IRS, they're going through their tests to classify, okay, is this a bona fide business or is this a hobby? If they were to classify you as a hobby, that would mean that you can't deduct any of your business expenses. So we just want to make sure that we keep it clean and keep those separated. And it also helps create a clear financial picture of how your business is performing. And it will save headache during tax season when you're deducting your business expenses, and it's much cleaner for your CPA or your or whoever is preparing your taxes when they're completing your return. So there are actually 2 apps that I really like that will help you with this. So one is FreshBooks and the other one is QuickBooks for self-employed individuals. So these here will help you track expenses, and you can actually link these to your business bank account and it'll easily import all of your transactions, and then you can categorize them appropriately. And this will make it a lot easier for tax prep. You can also run reports from these apps. You can send invoices, you can track mileage, etc. So of course, QuickBooks starts at only about $5 per month, and FreshBooks starts at about $10. So of course, that's the base. And of course, you can upgrade. There's different packages that will include more things that you can do with the app. Okay, moving on. So next, I would say you will want to know and manage your personal credit. So as a small business owner, your business credit is built upon your personal credit, especially during the startup phase. So much like in your personal life, your credit can control multiple things. It can control your access to capital. It's going to control what interest rates you're able to get. It can influence your insurance rates and so on. So it's imperative to first know where you stand with your credit so that you can respond accordingly. So I know a lot of people like to turn a blind eye, but this is particularly important for business owners, since not only your personal life depends on your credit, but also your business. Now, you are entitled by federal law to receive a free copy of your credit report from all 3 credit reporting agencies. So those 3 will be Equifax, Experian, and TransUnion. So you will want to pull your report from all 3 because there may be something reported on one that's not reported on the other. And you can retrieve these from annualcreditreport.com. Now you actually have a good perk right now. So due to the COVID-19, you can actually access all 3 of these reports on a weekly basis at this same website through April of next year. So you want to make sure you're consistently taking a look at your reports. So you're looking for fraud, you're looking for any wrong or outdated information. So you can file a dispute for any inaccurate information, and the credit agency or that creditor, they have to respond within 30 to 45 days. And if they do not respond in a timely manner, they must update the information as you requested, or they must delete it. So to manage your credit, it requires knowing what factors actually makes up your credit score. So typically when we speak of a credit score, we're referencing your FICO score. So this is a company that offers a credit risk model and a formula that provides a score to the creditors at their request. And they're using this score to assess their risk of loaning you money because they don't want to loan money and lose it. Now, there are a couple of other credit scoring models, Vantage being another popular one, but FICO is still the most popular one that most creditors will use when they're looking for your credit score. So the biggest portion that makes up your credit is your payment history. So it's pretty self-explanatory. So of course, it tracks how well you pay your bills on time. So the longer history that you have of on-time payments, the higher your credit score in this area. And of course, a history of late payments will have an adverse impact on your score. And then the next largest component is the amount owed, or you may hear the term utilization. So this is basically the percentage of credit that you are currently using. The lower, the better, with the utilization rate under 30% being the best. For example, if you have total available credit of $10,000, you should keep your utilization below $3,000 or 30%. So this is one of the fastest and most manageable ways to increase your score. So for the payment history or the length of credit history, the other component, those are just a factor of time. But utilization is one of the ones that you can manage and increase your score. You just have to make sure that you're paying your amounts down before that balance is reported. to the credit reporting agencies. And this is typically around your statement date. And next factor would be your length of credit history, which makes up 15%. So the longer your history, the better. It's just a function of time. So this includes the age of your oldest credit account, the age of your newest credit account, and the average age of all of your accounts. So a longer history gives creditors, of course, a better view of how you handle credit over time. Now you want to keep those older credit lines open to keep your score higher. Now that goes without saying, if there's a credit card that you've had for 10 years and you know that you aren't strong enough to manage that appropriately and that you may run the risk of running that credit card up too high, you have to remember that your utilization accounts for 30% of your score. So you kind of have to weigh, your options there. So I would say if you have to close it to control yourself and keep that utilization down, then you can do that. So the next factor would be that makes up 10% is your credit type or your credit mix. So individuals with top credit scores usually have a diverse portfolio of credit accounts, just different credit accounts. So this may include a car loan, it may include a credit card, a student loan, a mortgage, etc. The more diverse your portfolio, the greater the chance a creditor has to predict behavior according to the particular credit that you're asking for. And the last factor is new credit, and this makes up 10%. So this just includes the number of new credit accounts that you have opened and the number of hard inquiries made from applying for credit. So yes, every time you go to the department store and they ask, hey, do you want to save 20% by applying for this store credit card? That's making a hard inquiry on your credit report, and it influences your credit score overall. So too many accounts or inquiries, it can be a red flag to lenders, and it will indicate an increased risk, which can hurt your score. Okay, and my last tip for today is to save for retirement. Time is money, and when it comes to saving for retirement, you want to give your money the gift of time. So the longer you wait to contribute to retirement, the less time you have to take advantage of the time value of money and virtually grow your money over time. So the chart you see here below shows the power of $1 saved now versus later. So we can see that $1 saved when you're 20 years old will yield $5.84 at retirement versus the same dollar. It will only yield $2.47, so half that amount, if you wait until you're 40 years old to start saving for retirement. So this chart assumes an average rate of return of 4%, which is conservative and very achievable. So the earlier, the better that you can start saving for retirement. And saving for retirement is a race. So the faster and the stronger you come out of the gate, the better your outcome will be at the finish line. And here are just a couple of options for self-employed individuals to start saving for retirement. And this is just a very high level review. So even, I'll give you all these options, but you will want to discuss this with the financial advisor. There's not a one size fits all. There's not a one size fits all decision that's great for everyone. You want to make sure that advice is tailored to your certain situation. So first we have a traditional or Roth IRA. Now anyone can start and contribute to an IRA account, whether you're self-employed or you have an employer. These are available to everyone. So these are very, very easy to set up, and they're good for those that are just starting out. So you can contribute up to $6,000 a year, and for those that are 50 or older, can contribute another $1,000 on top of that for catch-up contributions. So a traditional IRA, that means that you're receiving a tax deduction right now for your contributions. In essence, your tax is deferred and you'll pay those taxes later during retirement when you withdraw the funds. A Roth IRA is the opposite. So that means you're paying that means that you'll pay your taxes now and you'll withdraw them tax-free later during retirement. So once again, there's no one size fits all. There's not a better choice for everyone. Your choice needs to take into account multiple factors, such as your tax bracket now versus your expected tax bracket at retirement. The next option is called a solo 401k. So this is for the business owner or self-employed person that has no employees. So this works just like your standard employer-sponsored 401k. You can make contributions with pre-tax dollars, and you can contribute up to $57,000 or 100% of earned income. So whichever one is smaller. And there's also an additional catch-up contribution for those 50 or older of $6,000. Your next one, the SEP IRA, this is also for self-employed individuals with no or few employees. So you can deduct the lesser of $57,000 or up to 25% of compensation. And that compensation is limited at $285,000. So this option may not work for those that are very, very high income earners. And next we have a simple IRA. So this is also a good option for small businesses, but with this one, you can have employees. You can have up to 100 employees. And for 2020, you can contribute up to $13,500 into an account like this. And for those that are 50 or older, there's an additional catch-up contribution that you can make of $3,000. So just like your traditional IRA, the contributions are tax deductible now, and you'll pay taxes later when you withdraw those funds during retirement. Next, we have a defined benefit plan, and this is for self-employed individuals with no employees, and they have high income, and you want to save very, very large amounts consistently. So your contribution limit is based on the benefit that you'll be receiving during retirement. It's also based on your age. It's also based on your expected investment returns. And now for this one, contributions are also tax deductible right now. So your contributions are made with pre-tax dollars, but an actuary is necessary to determine your contribution limits. So this one can carry a lot of administrative costs. It's basically like setting up a pension plan for yourself. But this one is very good for those that want to save a lot of money per year, because their limit will be based upon your particular compensation. So I would say this is more targeted for those that want to save upwards of like $60,000 or more a year. Now, most of these options you can open with the online brokers, but you should definitely consult with a financial planner, an advisor, maybe even your CPA to learn about the tax implications and what's the best option for you. So just a quick recap of what we went through of our top 5 personal finance tips. So number 1, we want to make sure that we're building an adequate savings fund, emergency stash. Just help you sleep a little better at night so you can ride out those business cycles when we go down and increase your chances of survival, because we saw that a lot of businesses fail within 5 years. So we want to make sure we have an emergency stash to keep running. You want to find and establish your dream team of subject matter experts. So as stated before, this would include an attorney for any legal or liability issues. It would include your financial advisor, so they can help you pick one of those retirement options that we just ran through. And it also will include your CPA to help you with your bookkeeping, your reporting, and most of all for good tax planning so you can save on taxes. We want to keep business and personal finances separate. Always keep these in separate bank accounts. When your business income is not your income. And so you want to make sure you're giving yourself a regular salary or taking distributions, which you would transfer to your personal account, and that's what you would use for your personal expenses and living. We want to know and manage our personal credit. So for small businesses, your personal credit is your business credit. So it's very important that you take care of it. And last but not least, you want to save for retirement. I stated before, time is money. So the faster and earlier you can start saving, the more time you're giving your money to grow. So you want to make sure you're saving for retirement as soon as you can. Okay, so that will wrap up the presentations. Yes, Chelsea, we can take Q&A.
Absolutely. Thank you for that great presentation, Tameka.
Thank you.
Definitely a few questions. So one attendee did ask if we could see the slides for step 1 again. So I don't know if you want to bring those up while we...
Yep, let me share again.
Yeah. And we can let that attendee take some notes on that while we talk about our other questions. There's a few really great ones here. So,
okay, which slide was that again?
Step 1. She was looking for those slides for step 1.
This guy here.
Yeah.
Yep, so this one's for your emergency fund. Yes. So anyone, whether you're self-employed or you have an employer, you should have an emergency fund. Like, emergencies are going to happen.
Yeah, and I think, the recent, the fact that we're doing this virtually, right, it kind of highlights that need for an emergency fund for individuals and for businesses.
Exactly.
For me, Tameka, what are your tips on building that emergency fund? Because that can be pretty hard from a budgeting standpoint. So what are some ways that you found success in that?
Well, for those that are, whether you're self-employed or have an employer, so you want to cut it down into smaller, more digestible goals. So a lot of people will look and say, oh my goodness, I can't save 3 to 6 months. So you want to break it down to digestible goals. So I would say immediately you want to save, at least have $1,000 in the bank at any time. I call that like your baby stash. So if something happens, you're riding on the freeway and hit a Michigan pothole and blow your tire and rim, you can go and replace that and not run up a credit card for something that's simple. So you just want to break it down into more smaller, digestible pieces. And then if you want to automate your savings. And so you want to have, of course, a separate savings account from your checking account. They are not linked. We know how that goes. When your checking account and your savings account is linked, we know, okay, we're at Target and we put some extra stuff in our basket and we can easily transfer it from our savings, then it's going to be in our checking account. So you want to make those automated transfers as you get paid into your savings account, kind of like out of sight, out of mind. And you should know, yourself how much you're disciplined. So maybe if you put it into an online savings account, where it's going to take you at least maybe 2 days to get your funds if you really need it. And that way you're not tempted with impulse buys as much.
Yeah, so I've definitely been
out of sight, out of mind.
I've been burned by my checking account pulling from my savings account before and overdrafting. Maybe once by a 69-cent song on iTunes, but that was a long time ago, right?
Yeah, that's how the banks make their money. They make so much money from those fees.
Yeah.
So it's very important. And then it's establish your budget, because if you don't have a budget, then that's probably where you're going into the negative, and then it's kind of like a snowball from there, right?
Mm-hmm. Yeah. Well, and speaking of fees, you talked a little bit about establishing your dream team. So one attendee asked, what's the best approach for finding a CPA?
I would say for CPA, you want to find someone that has experience in your particular industry. So I'm going to stop sharing. In your particular industry. So I would say the number one source for finding a good CPA will be word of mouth. Ask your friends, ask other people that are in the same industry as you. And so you will get a personal reference would be the best way, I would say. Because you don't want someone that's mostly servicing doctors and you're running a food truck. It's like two different industries, right? And so they're going to have an accountant that has a particular client base. They're going to be more well versed with those tax breaks and even how the accounting flows for it, the very basic accounting flows for it. So I would say your number one thing would be to get personal references from others that are in the same industry as you.
That's a great pro tip, Tameka. I like, now that you say it, it makes perfect sense, but it wouldn't have been something that I would have thought about, right? Like different industries have different things that are important.
Yeah.
So that's a great tip.
Yeah, like you're for an attorney, you want to go to someone that was, mostly like for estate planning. You want to go to a defense attorney for that. Like, so you would just want to find someone that's well versed in that particular industry.
Absolutely. And, so you recommended a couple of different products. And so Leander wanted to know, which do you prefer? Do you prefer QuickBooks or FreshBooks? And talk to us a little bit more about those products.
So as an accountant, I prefer QuickBooks because I'm just more used to it. Where FreshBooks is a little bit easier to use if you're not an accountant. And it's just a lot more, especially on your mobile device, I think it's a little bit cleaner to use. But I think QuickBooks has a lot more functions that you can use, but it may go over your head if you're not, really into those details. Both very good apps, though.
Good, thank you. Okay, so this one's a pretty involved question. So given the July 15th tax return due date this year, mm-hmm. and I'm assuming this means this person owes the IRS. They typed own. I don't think they own the IRS, but they owe the IRS. Is it better to fund the IRA, a health savings account, or something else like that to reduce tax liability? And are there any other ways to reduce your tax liability before the deadline?
Yeah, so I'd say it's probably kind of late now because I know a lot of your contributions to like your health savings account and I think those had to be made by March. Don't quote me on that. So like right as I said before, it's kind of late in the game to try to minimize your taxes now. So tax planning needs to be a strategy, year-round strategy that you sit down with your CPA well in advance of your return and figure out, okay, how do I minimize my taxes that are going to be due? Or whatever, and actually, if you're expected to owe $1,000 or more in taxes, you should be paying estimated quarterly taxes anyway. So there should be a conversation that comes up. You should be meeting with your accountant or at least talking with them at least quarterly, and so those tax planning conversations could happen then.
Okay, so that is something that your dream team CPA would be able to help you with.
For sure.
Okay.
For sure.
A couple of questions about your credit score and creditworthiness. So does paying credits weekly increase your credit score faster?
Monitoring it weekly?
It says paying your creditors weekly.
I would say it doesn't. You just have to they're only reporting the balance one time a month. So that's usually around your statement date. And you can especially now is a really good time because you can access your credit report every single week. And so you can go in and you can figure out, okay, this creditor looks like they're reporting on this particular date. So you just want to make sure that balance is down as of that date that they're reporting it. So they're not going to report it every single week. So say your creditor is reporting to the credit agencies on the 15th of the month. You just want to make sure that that balance is paid down before then. So if you had a $3,000 balance and you're, over your 30% utilization rate, so you just want to make sure that you're paying that down, I would say by the 14th at the latest to make sure that they're reporting, the smaller balance.
Mm-hmm. Okay. While we're on the topic of credit score, so you talked a little bit about reducing your utilization rate, but what are tips for increasing your credit score? Maybe for folks who've had some challenges in the past, what are other ways that you can improve that credit score besides just time?
Right. So for especially for the so either for those starting out or somebody that's trying to rebuild their credit, of course you're not going to have a lot of people beating down your door to give you credit cards, right? So one good option is to get a secure credit card. And so you can go to almost any bank and get this. So what you're doing is you're basically going in there, you're putting down a deposit. So I'll give the bank a deposit for $300. They'll give me a credit line for $300. So that's basically collateral for them if you default. And over time, they'll increase, that credit score, and they'll increase that credit line. I'm sorry, and that'll help your credit score. So that's a very good place for people to start out if you're new, you don't have any credit at all, or you're trying to build your credit. And then also, if you can have someone add you as an authorized user, that they're responsible on with their credit. If they can add you as an authorized user, that will help build your credit history as well. So, for example, my son he's a teenager, so he's getting up there in age. So I'm going to add him as an authorized user to my credit card. I'm not going to give him a physical credit card, but I'll add him as an authorized user to my credit card. And that way he can start building that credit history, if that makes sense.
Mm-hmm. Absolutely. All right. So a question on retirement accounts. I'm able to start a solo 401k or a SEP simple IRA if you're a high income earner and have a business on the side.
Yes. And so actually, I think it was the solo. Let me go back to my notes here. The solo had the higher income rate. Yeah, so the solo, you can contribute up to $57,000 or 100% of your earned income. So it is the lesser of those two. So as long as you have earned income, you can contribute 100% of that or $57,000, whichever one is lower. So that's very high to contribute, and it'll be pre-tax dollars. So that'll be another strategy to bring down your tax bill right now. So you'll owe taxes later when you withdraw. So it kind of depends. You have to balance what you expect your tax bracket to be in retirement versus what it is now. Is it better if I pay the taxes now on this money or later? So it's kind of like a balancing act that's based on a lot of factors.
Mm-hmm. Yeah. So can you tell us a little bit more? Because this is something that I just learned about not too long ago, was like having diversified retirement accounts, some pre-tax and post-tax. Can you tell us about some of that and like what things to look out for?
Yeah, so I would say a lot of people get caught up on trying to like kind of work their own portfolios. So I would say 90% of us are not investment experts. I'm not even an investment expert. So I let the experts handle it. So for me, I call myself a lazy investor. And so I just put all mine into a target date fund. So what a target date fund is saying, okay, I plan to retire in 2050. So I have some time to retirement. So when you have more time, so right now they're going to put it into a little bit more risky stuff, more stocks and stuff, because you have time to rebound. And as you get closer to retirement, they're going to pull back and they're going to put it into more conservative things, like maybe municipal bonds, a little treasury bills, stuff that you don't have as much risk to lose. And so, like I said, I don't manage it myself. I put it into a target date fund, a Vanguard, in particular target date fund, and there's experts that's managing that fund. So for example, my retirement account back in March, when we know the market totally tanked, I looked at my retirement account and it was down 30%. Now, a lot of people, they were panicked. They were like, should I withdraw my money or anything? It's like, no, not at all. Like, you have time. So a lot of people, they move their monies or whatever. But you have to remember, those losses are just losses on paper. So you're not locking in those losses until you actually withdraw cash. And even now, I looked at the retirement account. So, okay, it's down 30%. And look, within the last week, it's only down 3% now. So it's basically rebounded. So we just have to remember that. And like I said, if you're not well versed, just let the experts handle it. Put it into a target date fund or something like that. Something you don't have to constantly keep an eye on, because you have experts watching it for you.
Mm-hmm. And Tameka, what are some resources that you would recommend for folks who want to learn maybe like not everything about retirement accounts, but like learn a little bit more, especially for folks who maybe are those self-employed people or small business owners who don't necessarily have like a person at their job that they can talk to about this? What resources do you recommend?
Yeah, I'll say even if you go to like your bank and speak with a banker there, they can at least tell you like the options. And they're going to try to sell you hard. So they're going to give you as much information as you drill and ask for. So I would say that's a good starting place without having to, actually employ somebody to get their advice. Just go to your local bank and see what options they offer there.
And on the topic of banks, another participant question from Tracy. Tracy asks, is it still best to open a credit card through a credit union as opposed to a regular bank, since credit unions have a ceiling for the interest rate charge?
I would say for me, like the interest rate it's important, but it's not as important because I pay my bills down to zero. So I'm not paying interest, whether I have a rate of 5% versus 10%, I'm not paying interest because I'm paying my balance down. But if you're carrying a balance, of course, you want to go with whoever has a lower interest rate. That goes without saying.
Another question about the stock market and retirement. Mm-hmm. So Leander asks, seeing how the market is now, would you recommend sticking to an IRA? No, for myself, I'm not too confident that the 401k will be around by the time I retire. I think IRA is a safe route to go because I am controlling my investment. What do you think?
For me, I'm not an expert for investments, so I stick the money into even an IRA. The IRA and the 401k is basically the same thing. It's just what you're putting inside the accounts, right? So I can have a 401k full of bonds. I can even have cash balances in there. An IRA, you can have the same thing. You can have stocks, bonds. It's just a matter of what you put in there. And so I choose to I have mine through Vanguard, so I'm not constantly keeping an eye on it. Because I know those people, that's their day job. They keep an eye on it for me.
Gotcha. Well, Tameka, it looks like we've gone through all of our questions from our participants. Do you have any? Oh, just kidding. This is a good one.
Bring them on.
I'm not sure either. What are Vanguard fees?
I think they're pretty low, and I'm actually I'm still employed, so I don't have to worry about fees. My employer pays them, but I think they're pretty low.
Okay, and that's like a fee that a person would pay for an account, right?
It's like because they're managing it for you, so they have to make money somehow, right? So yeah.
So friends, a couple more minutes. We still have about 10 minutes with Tameka here. So if you have any additional questions that you're still percolating on, go ahead and pop those in that Q&A box or in the chat box so that Tameka has a chance to answer them. And just while folks are chewing on that, Tameka, do you have any other final thoughts to share with us?
Yeah, I would say for you guys, I'm on Instagram, Millennial Mom+Money on Instagram, and you can also check out my blog, millennialmommoney.com.
Awesome.
You can shoot me any questions there or anything. And if you have any other questions, you can shoot me an email, admin, ADMIN, at millennialmommoney.com.
So a couple more questions came in.
Okay, good.
Just needed a minute to think about it, right? So I'm about to start at Adobe as a financial analyst. Congratulations.
Yeah.
Recommend matching your 401k?
So if you're going through your employer, you have to see what options they have available. And so I know certain employers, you may only have one option versus another, you may have 10 options. So it really depends on what your employer offers.
Okay. And then going back to the prepaid option, I'm assuming this person is talking about our secured credit cards that we were talking about. What would I ask for at the bank to build my credit?
Yep, so that product is called, it's a secured credit card, and they should be able to give you more information on that. So basically you're just instead of them just blindly giving you a credit card, you're giving them cash as collateral. And over time, they'll increase that credit limit. So I know some people are saying, like, why would I give you $300 to get a $300 credit limit? But it's just a starting place for you to start building your credit. And that credit line should increase over time. Of course, increase your credit score, and you'll can apply for other forms of credit as well.
Are you able to talk through any of the changes that have occurred regarding accessing 401k with the CARES Act?
Yep, so I know a little bit about that. So with accessing your 401k, they did change a lot of things. So I know one thing, if you withdraw from your 401k, you actually have more time to pay those taxes. So say you withdraw those penalties. So under normal circumstances, if you withdraw from your 401k before you're 59 and a half years old, not only will you have to pay the income taxes because you didn't pay taxes on that money yet, but you'll also have to pay a 10% penalty. So right now with the CARES Act, if you withdraw that money, and you have to prove that you were impacted by COVID, obviously, they're removing that 10% penalty. And you still have to pay the income taxes, but you have longer to pay. I think you have 3 years to pay it instead of having to pay it all come the next tax season. And also on the other side, instead of withdrawals, you have loans. They increased that limit to $100,000 versus that's typically $50,000. And I think they also gave you longer to pay that money back as well. So if you take a loan from your 401k, you don't have to pay that 10% penalty under normal circumstances either, but they did give you longer to put that money back into their 401k. But you have to usually, I think they're like, it's not too involved now, but they do at least ask, okay, were you impacted by COVID somehow? So were you diagnosed with COVID? Did you have a spouse diagnosed with COVID? Something like that. Did you have job loss, obviously, and your income was reduced due to COVID?
That's great to know. Thanks for going through that, Tameka. Mm-hmm. And our last question from Alicia, what do you recommend with 3 different home-based businesses as far as percentages of parts of home, for example, using one office for all 3 businesses?
Yeah, I would say so. It's very important, for one, to use an office that's solely business-based. So you can't use this as your chill-out time on, in the evenings. Like, it has to be solely business-based. So if an IRS audit comes, you can prove, like, okay, I'm using this space only for business. And that's it also that raises your audit risk. So you want to make sure that you're just using that particular room for business. So it may be kind of hard to prove if you're saying, okay, I'm using all 3 of my rooms for business. They may be kind of hard to prove later on.
Yeah. Sounds like a great place to tap your dream team as well when we get down into those nitty-gritty.
For sure. And in a home-based business, you're opening yourself up to a lot more deductions that you can take. So if you're a home-based business, now you can deduct way more about business mileage because that's your primary place of business. So you get in the car, you run to the post office, hey, that's a business trip now, right? And so there's a lot. And then, of course, part of your mortgage, you can now expense that as part of your business, your utilities, your property taxes. So that's a very good point to bring up with your CPA when you're planning for your taxes.
Absolutely. Well, Tameka, thank you so much for all of the great finance information and for folks and for their businesses.
Thank you, Chelsea. Gracious hosts.
And definitely to our attendees, check out Tameka on Instagram and her blog. And also look for a recording for this session. So you'll want to share it with your friends and family. So that'll end up on the Detroit Startup Week YouTube shortly. And do enjoy the rest of this week's events and the socials tonight and events for tomorrow. That's all that we have for you all, folks. Enjoy the rest of your evening. Get outside if you haven't yet. Enjoy the last few minutes of this beautiful weather.
I'm going right now. Thank you, everyone. I really appreciate you joining your questions.
Yes. All right. Have a good night, everyone.
Have a good night.